When it comes to financial literacy, it is up to you to take control of your finances. Now, for me personally, it is about the debt-free journey and the education that I provide to you guys. So in today's video, it is an entire week's compilation to include some of our investing videos, some of our finance videos, also some of the ability to save money, as well as some unusual things. So let me know in the comments what you guys think, and thank you guys for watching. When it comes to managing your money, it's not too intuitive. And of course, there can be a lot of challenges, especially when you're starting out like I was many years ago. That's the big reason why I started this YouTube channel and trying to make it easier for us to manage money. So in today's video, we're going to be looking at 4 genius and practical money tips from Tony Robbins. And I want to break these down because the financial wisdom and the cost of not adhering to these or not following these can be very great. So the first one is harnessing the power of compounding interest. Now, there was a multitude of years until I was actually in my mid-30s where I really understood compounding interest, even looking at the stock market, CDs, things of that nature, where you can actually turn your money, your savings, your investment into a machine that literally can compound and double every 7 years, which is roughly the estimation that they use. When you start thinking of retirement planning, when you start looking at a child's education, even thinking of you, the most powerful thing that we do have in our toolkit is time. When you think about the unsurmountable edge, really the ability to compound that money, when you think of Warren Buffett, when you think of the great investors that we see of our time, it is about investing on a consistent basis and allowing that money to grow over an extended amount of time. Now, of course, the younger you are, the earlier that you start. If you're 18, if you're 20, if you start putting money into IRA accounts, Roth IRA accounts, if you start putting it into your 401k, leveraging compounding interest can make monster goals when it comes to retirement very, very realistic, very doable, and honestly, a lot less intimidating when you look at a full figure where, hey, fully funded retirement, people are saying 1.2, 1.4 million. If you start breaking that down over 40 or 50 years with regular contributions and that compounding interest over time, it can make it very achievable. Now, of course, the compounding effect isn't linear. It is exponentially on the amount of money you have. So you can start growing. And honestly, when you start looking at someone like Warren Buffett with his large portfolio, when he hit the age of 65, the compounding just goes off the scale. When you look from 65 to 70, from 65 to 75, even 65 to 85, it is incredible how fast and how much it can compound. When you start even thinking of high yield savings accounts, bonds, mutual funds, investments, it is starting early, staying consistent, which if I knew this 10 years earlier than I did starting really at 35 to put a lot of money into my 401k, I would have much higher balances than I do today. And what we look at is knowing the difference between the pre-tax and the post-tax retirement plan. This is, again, something that I really realized and emphasized later in life when I started getting to the point of having the opportunity to put money into Roth accounts. So instead of having those pre-tax accounts at a younger age, starting to build up and have those Roth accounts at a much younger age, it makes a big difference. It may not look like it today, but when you start getting into retirement, when you start being required to take those RMDs, I know not only the contributions you put in there, but taking it on the growth as well, it can make a big game-changing difference. And if you're looking to create generational wealth like I am, the Roth one is a lot easier to pass on as inheritance to your kids. And while millions of Americans have a retirement account in place, scary point is they don't have and they don't know what the taxes are going to be in the future. For you and I, if we had a crystal ball, that would make it incredibly clear. But as it sits right now, taxes in the future are going to be higher than they are now. Possibility is yes, depending on what the brackets are, what exactly they're going to look like. That is the exact reason when I look at putting a portion of my earnings into that Roth, I do it in the entirety. So the way that I did it and the way that I feel like it could work for you as well is doing it kind of mathematically. So what I'm thinking is, in addition to Social Security, when it comes to my investing strategy, I am putting roughly 20% of my investment portfolio into a traditional or a tax advantage account, putting 80% in the Roth. So as you can see, there is a very, very big chunk that I'm putting into the Roth with all of my contributions, everything. 80% of that contribution is going into the Roth. It is going into my Roth 401k. Now, the reason for this is because right now, we are in a very high tax bracket. Chances are we are going to be in a much lower tax bracket when we get into retirement. But that is going to be the point where I'm going to have to start taking money out of those pre-tax accounts. That is the money that I am planning, that 20% in that retirement portfolio is what I'm anticipating I'm going to need and really be able to utilize during retirement through RMDs, through regular distributions, making sure that that is going to be the paycheck that I'm going to be cashing out during retirement. That leaves 80% of my investable assets that are in that Roth variant, meaning the taxes are already paid. It is growing tax-free. When I retire at the age of 50, 65, whatever it may be, I am going to have a multitude of years to continue the compounding interest that we're going to see in those accounts, because I do not have a plan at this point and even in the future to touch any of the money that is in those Roth accounts. Now, looking at number 3, committed to consistent savings. This again is one of the big things. It doesn't matter if you earn 30K, 50K, 100K, $1 million a year. If you're not saving anything from your paycheck, it doesn't make sense. When you start looking at this and setting aside a fixed amount every single week into a savings account, into an investment account, this is the kind of steady growth. I mean, when you think of an entire mountain, let's say you're climbing Everest, it is going to be one step at a time. Think of the exact same thing when it comes to the commitment to savings. If you want to retire and be wealthy when you retire, have a fully funded retirement plan, it is going to be that one step at a time of making contributions every single time you get your paycheck. And this, of course, is going to lead to the compounding interest. And it also develops and really teaches you a much more disciplined approach to your spending habits and how you really present the financial reality of what it is today. If you're making, let's say, again, $5,000 a month, if you're spending $5,000 a month, there's nothing left for savings. There's nothing left for investments. There is nothing left in its entirety. You have to make a commitment where if you're making that $5,000 and you're living on, let's say, $4,000, that gives you $1,000 every single month that you can free up, that you can use in a lot of different places. This, of course, is going to vary greatly person to person. When you start looking at this, let's say you commit right now as today, 3%, 5%, 10%, that you're going to start an IRA, that you're going to put money into your 401k. Starting and committing to that consistent savings is going to be the game changer for the rest of your life. And if you ever want to be financially free, it is the only way that you're going to achieve that. And the fourth one is broadening your financial knowledge. This is exactly what you're doing here. And if you like the content that I'm putting out, please subscribe to the channel. We are well on our way to our 10,000 subscriber mark, just hitting 7,000 right around the corner. But when you start thinking of financial knowledge, even bigger picture, how do you save money? How do you budget? What is the spending plan? What do IRA accounts look like? What is a Roth? What is a traditional IRA? You need to know your financial acronyms. You need to have the financial knowledge to even make a very basic common decisions. This is something, unfortunately, that we do not see taught in school at all. And I'm really kind of taken back by this. Where I live in Michigan, we actually just passed something that high school seniors are going to require a half an hour of financial education. But honestly, you got to know how to read financial statements, how to read bank statements, how to write checks. You need to be and honestly, you're the only one that is going to be accountable when it comes to the financial knowledge that you have, when it comes to investing, when it comes to cryptocurrency, when it comes to anything, guys. Make sure you know it, you understand it, you can explain it, not just the very basic service level of knowing it, but looking at financial books, looking at courses, looking at, YouTube videos, webinars, online articles, books. There are so many things that can increase your financial literacy. And again, that is the exact reason why I started this channel. When I started dealing and doing a lot of the financial education and counseling piece, I quickly realized that when it comes to a younger generation, they do not know really anything about financial literacy and knowing how to invest, where to invest, what a portfolio looks like, what a brokerage account is. It was kind of crazy to see the massive gaps between the generation and making sure that my kids are not going to be subject to that. They're going to be well educated when it comes to the financial knowledge that they possess. So guys, that's going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching. When it comes to investing, you really have two solid investment choices. The first one, you can invest broadly into something like the VOO, the S&P 500, or you can fine tune those selections to meet specific needs that we're building in a portfolio. In today's video, we're going to be looking at two high yield dividend ETFs that I focus on and that I'm building portfolios around. And one of these I do hold in my own portfolio. So looking at these two, and the two that I've chosen is the Vanguard High Dividend Yield ETF, which is the VYM, and then the Invesco S&P 500 High Dividend Low Volatility ETF, which is the SPHD. So a little bit different than we've seen in the past, and how to decide exactly which one of these are for you. And if you hold either of these, let me know in the comments down below what percentage you hold in your portfolio. So what does the Vanguard High Dividend Yield ETF actually do? This is getting down and breaking the fundamentals of what it does. Exchange traded funds, index based. It follows the FTSE High Dividend Yield Index. So the fund charges a 0.06 expense ratio, which is super low, but what exactly does it do? Thinking of this one, it's pretty simple to understand. This is more of a basic one. Selects all the dividend stocks in the stock market. So think about that. When you look at diversification, it looks at all of the dividend stocks in the stock market. It removes real estate investment trusts or those REITs out of there, which is odd because those are income generators. After this step, it lines up the dividend stocks that are left from the highest yield to the lowest yield. So when we think of like the debt snowball, anything like that, it is the highest yield to the lowest yield, selecting the highest yield 50% of the list of the final portfolio. So you are getting the 50% of the cut that they have left of the highest yielding 50% for the list of the portfolio. And then it goes into a market cap weight. So large stocks have a greater influence over this ETF and the performance of it. And then when you start looking at that, it's pretty interesting because it provides a very broad diversification overall. Now, the Vanguard High Dividend Yield ETF owns over 500 stocks. This is not just looking at large cap itself, but it's looking at the dividend of the entire stock market itself that provides, of course, a broad diversification, which I love. So many stocks, it could end up diluting the ETF's yield, which is around 2.8%. Pretty good when you do in comparison to the S&P 500, which is a 1.2%. So you're over double and you have the diversification by putting money into this ETF. Now, of course, the VYM is something I personally do hold in my portfolio. Looking and really picking and choosing which one you want to hold, there are a lot of dividend paying ETFs. Now, the second one we're looking at is the Invesco S&P 500 High Dividend Low Volatility ETF. What exactly does that do? And this is where research and development, knowing exactly what you're investing in, it lives at the opposite extreme of the index than we just looked at. Starters, it starts with a S&P 500, which we know the index is hand selected to include largest, most economical reserve companies in the United States from the start. Then the Invesco S&P 500 High Dividend Low Volatility ETF, that's a lot to say, is doing something different completely than what we see in the other ETF. The next step in this one, which tracks the S&P 500, is to rank the S&P 500 from the highest yield to the lowest yield. Like we've seen, the 75 highest yielding stocks are selected with a limit of 10 stocks per sector. So when you think of all of the sectors that make up that S&P 500, it is only choosing 75 high yield stocks with a cap of 10 stocks in each sector. So if you think about that, if you have a sector, let's say for instance, the financial sector, where you have a ton of companies that fall within that 75 highest yielding stocks, they are only going to select 10, and 10 is going to be the cap before it moves on to another sector. If that limit is reached, other sectors are added up to the list, back into the 75 stocks. 75 stocks are then ranked by standard deviation, measure of volatility, and the least volatile 50 make it into the ETF, and this is weighted by a trailing dividend. So again, a little bit different. Radically different when it comes to this, focusing on over really the high yield over the diversification. When we started looking at the VYM, it was all about the diversification, holding those 500 companies. This one holds 75, which means it's a lot more focused on the dividend yield in here. Now, the trade-off, of course, is you kind of lose some of the diversification, but in the flip side, you do get a higher yield at 3.5%. When we start looking at high yield savings account CDs, everything of that nature, they are slowly going away on the expense ratio, a little bit higher at a 0.3%, which of course is a negative, but this is something that is truly one of those funds that you see overall doing pretty well in the way that it's managed and the way that the ETF itself is built. But that being said, the ETF's historical performance hasn't been great over time with the yield. This, of course, is due to the market volatility. And without the diversification, they are losing quite a bit more than we've seen before. So when it comes to which one is right for your portfolio, this is where it kind of sums it up. Really make it logical. The first one, the Invesco, the S&P 500, the high yield dividend or high dividend, low volatility, looks at low volatility stocks. So you have a little bit less kind of risk mitigation there. It's the slow and steady builder that we see, very slow and steady dividend growth, focuses on the higher, larger yield stocks, which of course gives you a little bit better return. But when we start looking at these side by side, between these two ETFs, of course, it is very personalized to what you like. But when you start looking at maximizing income, perhaps supplement Social Security, which we're looking to do in retirement, that is the reason why I focus on dividend ETFs and why I look at the percentage that I put in there right now. As it sits today, I do have 40% into a growth ETF. Now, there's a lot of different growth ETFs out there that you can absolutely focus on and build. The second 30% that I'm doing is in something like this. That is a high dividend yield ETF. I have the HD, I have the VYM that I do carry in different portfolios. And then of course, the final piece of this is the foundational or the core. We're looking at the VOO or the VTI. Either of those are going to be really the core index to build a 3 ETF portfolio, which does incredibly well. So when you start looking at this and thinking of retirement, it would be the Invesco that would win out during retirement. But looking and suggesting that Vanguard high dividend yield ETF, not a bad choice at all. It depends where you are on your personal investment journey. Again, if you're younger, if you have a little bit more volatility, when you think of the Vanguard high dividend yield ETF, which is the one that I do own, it makes sense because we're seeing a lot more of that growth factor out of those 500 companies that we have within the S&P 500 versus those 75. Even though it is giving you a higher dividend yield, you're not quite seeing the growth out of there. This is going to make a big difference where you are personally on your financial journey and looking kind of at the gains over the last multitude of years. Looking at about the last decade, the Invesco S&P has yielded about a 54% price change. So it has went up considerably. But when you start looking at the Vanguard high yield dividend, it has went up about 86. So definitely considerably more. And then when you start looking even at the total return, 130 on that Invesco S&P, 156 in the Vanguard high yield dividend. So again, even though the Invesco S&P 500 is paying a little bit more of a return, we are not seeing the growth factor out of there, which results over the last 10 years with it lagging a little bit. So again, personally, guys, I do own the Vanguard High Yield Dividend ETF, the VYM. But let me know in the comments what you guys think about these two ETFs. And as always, thank you guys for watching. When it comes to investing, you don't have to make it super complicated. Sure, you can go ahead, you can research individual stocks, you can look at their balance sheets, you can go in depth with them, and you could buy and hold potential winners, but you could also lose a lot of money over a long time on buying one specific stock. Now, we have a much easier path that I do follow personally. That is the exchange traded funds or the ETFs. Now, this is a very simple, convenient way to buy really a broad basket of stocks. Diversification in here is a must. And Vanguard makes some of the best ETFs that I have, and most of them I do hold on a personal level. So in today's video, we're going to be looking at 3 Vanguard ETFs to buy and hold literally forever. So let's go ahead and get into this. The first one we're going to be breaking down is the VOO or the Vanguard S&P 500 ETF. Now, this is one that I actually hold in my portfolio and hold in a big manner. And I want to break down kind of the logic behind it and the reason. So looking at the VOO itself, it encompasses the entire S&P 500 index, which means when you look at the investments of this, you're investing in 503 stocks. You're investing into every sector that the stock market has, meaning when you're putting money into the VOO, it is instant diversification when it comes to building it. It is a large blend domestic stocks. Now, one thing to remember with all 3 of these from Vanguard, they are US based. Now, there's a big kind of play, a big conversation that has been had about the diversification of international. When you start thinking of larger companies within the VOO, When you think of Nvidia, when you think of Alphabet, when you think of Microsoft, Apple, all of these large companies are global companies. That is the reason why personally I do not invest into international companies. Is a lot of the larger companies, when we get into the US space, is and really do have an international presence. So let's go ahead, let's break this down. And looking at this over, you can see the overview right here. They have a large blend. Now looking at the performance, and of course, previous performance is not indicative to what we're going to see in the future, but so far year to date is 24.47%. That is crazy when you look at the growth that we have seen in the S&P 500 this year. That is not typical. Normally the VOO or the S&P 500 is running about 10% even over the last 10 years. I believe is right around 10.6%. So you're getting a 10% return, and also you're getting a very consistent 10% return, which is the reason why I do love holding this fund. Now, the other thing you'll note is the expense ratio. This is incredibly, incredibly low when it comes to the expense ratio, a 0.03. When we start thinking of the variations of this with mutual funds, with financial advisors, you could go ahead and invest in this. Most of the mutual funds are about 1%. If you have a financial advisor, it's possibly 1% or north of 1%, meaning that in the course of your investing journey of your entire life, you could be giving away roughly 30% of your portfolio over, again, the investment portfolio in your entire life if you're utilizing a financial advisor. And of course, if you are going and investing in mutual funds, because mutual funds are managed funds, they have a lot higher price tag along with them. Now, Warren Buffett notoriously has said that everybody should own the S&P 500. Everyone should be into an ETF like this, and they should be into it roughly 80% of your portfolio in the VOO. Now, again, looking at the ones that you can buy in here and really hold forever, I want to break it down at the end of this, so definitely getting through this. So performance and fees. This, again, is kind of the summary that you need to look at. So looking at month end down a little bit, that's okay. Your 3-month, 3.6%. And as we get through here, year to date, like I said, around 20%. 1 year, so looking at the past 12 months, we are up 38% in this, which again is kind of crazy. When you look at the 3-year, you're at 9%, even the 5-year at a 15.21% return. That is incredible. That is a really strong return. And of course, it's because AI has been driven it. Nvidia, Apple, all of these larger tech companies have been doing incredibly well with the growth factor. 10 years, almost 13%. And even since inception, guys, right there, 14.52%. That is incredible to see the growth that we have seen over the last, or since inception. So that's what, 14 years, 14.52%. If you were putting in here and dollar cost averaging into this on a regular basis, you would have a exponentially a much higher return through the dollar cost averaging feature, which is exactly what I did, because there has been a couple years where the S&P 500 has went down a little bit. Now, of course, this is using the average. So when the S&P 500 declines, so let's say looking back at 2021, when we started seeing the S&P 500 actually pull back, buying during that time. And again, going back to Warren Buffett's philosophy, when there's blood in the streets, you buy. When things are red, that is the time you should be buying. That is where you're getting it discounted. For instance, with this ETF, looking again a couple years ago, when you start looking, and I believe we can do annually, when you start looking at some of these years ago that are right here. So 2022, you can see we were down 18%. So think about that. If it is down 18%, every single dollar you're putting in there, you are getting an 18% discount on the investing in 2022. Now, for me personally, I dollar cost average every single week. For the entirety of 2022, I invested time and time and time again every single week for 52 weeks, meaning when the market recovered the following 2 years, it has been incredibly, incredibly strong. Very good returns. We are almost at 100% return in 3 years through dollar cost averaging, which again is kind of crazy. Now, when you start looking at the expense ratio, again, a 0.03, definitely very good when you compare it to the average for very similar funds. When we start looking at the price is what it is, guys. When you start buying into something like this, you're not going to come in, you're not going to buy the whole ETF shares unless, of course, $538, but it is fractional shares. And even looking down below, I have a link to M1 Finance where you can invest in fractional shares. So again, looking at the prices and where it's built, definitely doing well. But when we start looking at this, again, 504 stocks are within here. That is because some companies do offer 2 different kinds of stocks. which are the same stock within there. Not a huge return when it comes to the dividend ratio, but when you start looking at the sectors, this is where it is market weighted, meaning for those information technology, those IT companies like your Apple, your Nvidia, your Google, all of those, and you can see right here, the VOO 31.5 or 0.70. So almost 30% of your entire portfolio is in in information technology. So making a really big weight. And you can see the benchmark here. It tracks the benchmark. It tracks that S&P 500 index. That's exactly what we want to do. But you can see with all of the sectors, it is instant diversification through everything, meaning that the highs and lows will not be as high or low because it is not driven. We're not putting 100% into IT or information technology. We have it balanced out with a lot of other sectors in here, making it very important and really diverse when it comes to building this one out with the VOO. Now, the second one we get into is the VOO's little brother, the IVOO. This is the Vanguard S&P Mid Cap 400. So we are no longer looking at the S&P 500, which of course is the 500 largest companies in America. We are looking at the mid cap. Now, these do have a special parameter to fall into this mid cap. So I really want to break this down. And if you remember from where we were with the VOO, when we start looking at this overview, this is returning 16.61% so far year to date. So doing very well in the return, not quite as high as that S&P 500. And the reason for that is the tech stocks that are driving that. This, of course, represents 400 medium-sized companies in the US. So when you think of the convergence of having both that S&P 500 fund and then this mid-cap, you are looking at your 500 companies plus your 400. You have 900 companies in the United States that you're going ahead and you're investing in. Now, the market price for this one, quite a bit lower, but when we start looking at the summary, very similar to what we've seen with that S&P 500 fund, we are at 32%. And then, of course, the 3-year at 5%. The 5-year is at 11, and the 10-year is almost at 10%. Since inception, 12%. So still not quite at the 14% that we're seeing the run rate with that S&P 500, but the mid cap does hold its own value because you are outside of so heavily vested and so heavily invested into those large tech companies. Where again, if we don't see AI take off like it was, if we see a pullback in semiconductors or anything when it comes to the IT sector, this can make a big difference and this can actually perform a lot better. And traditionally, depending on the market, depending on the economy, the mid caps and the small caps have performed incredibly well. Looking at the price, significantly cheaper to get into this one. And then of course, looking at overall the index and the way that this is built, I want to go through the portfolio because we have 401 stocks here. But overall, again, growth rate about 15%, so pretty good. Now, the big thing to note with this is the mid cap. Before it was a large blend when we seen the S&P 500. This is the mid blend using a lot of these companies. And you'll also notice the P&E ratio. This is the big difference. When it comes to the profits and earning ratio, it is significantly lower than what we see, again, of those really high tech companies, which can be a little bit cautious because a lot of people are saying that those larger tech companies are very overvalued, meaning there's not as much room for growth with those. And these mid caps have a lot of room and a lot of runway to go ahead and build those. Now, of course, it goes through the risk, but looking at our sectors, information technology, 9%. This is the difference. When you think of that S&P 500, we were at 32% for the information technology. This is not reliant. So again, if we see a pullback from the IT sector within that S&P 500, we are not going to feel the effect and we're not going to see as down of a market than we've seen before. We're a lot more focused in this one in the industrials, as you can see, the financial, discretionary spender, consumer discretionary. So that makes up a big bulk of this when it comes to the companies. And of course, these are not the mega cap companies that drive the S&P 500 or drive the economy itself. And the third and final one we look at is VB, which is the Vanguard Small Cap ETF. So this one is looking at the small cap. Expense ratio on this one, a 0.05. So still super cheap when it comes. Now, you also notice right here, Admiral shares, all of these do come in a managed mutual fund. Mutual funds do come, again, with a little bit more of a cost associated with it. When we look at the overview of this one, you can see doing pretty well, even doing a little bit better than we've seen with those mid caps. Small caps and small, really, companies have a lot of room for exponential growth. These are the companies, even looking again, thinking mid cap and small cap, these are the companies that support a lot of those larger cap companies that are your tier 2 or tier 3 suppliers, even thinking of like the big 3, or really developing and building, they're the backbone really of the United States, with these companies that are supporting all of these larger companies and the growth aspect that they do have in there. So breaking this one down with our performance, overall, you can see a little bit lower over the last 20 years. So we are going back another 6 years, which of course, this does include the housing market 2007, 2008, because if you looked at the S&P 500 fund, it was 2010. So this does go back 6 years earlier. So a little bit further down for that reason specifically. But when we start looking again at some of the pullback, and when you start looking at the annual growth, it is not as far back and it doesn't pull as far back than we see with those S&P 500 funds, but it also doesn't peak and doesn't have as many of those very, very high gains. You're not up, 20, 30, 40%. It is more of a relative kind of solid, steady growth within the smaller caps. Now, when you look at this one as well, there are a lot more companies when we go through and kind of break this down. You can see there's 1,383 companies. But when you think of your portfolio composition, this is very important. So large cap, mid cap, small cap, we are building and really having the blend of all three of these Vanguard funds. So when you think of the entirety of the stock market itself, you are building everything out itself. So a lot of people will ask, why don't we just invest in the VTI? Now the VTI is the Vanguard Total Index, meaning that it includes the large cap, the mid cap, and the small cap. The reason being, with these three ETFs specifically, you can build a portfolio that kind of encompasses everything, and you can do it at different percentages. Now, for me personally, if I was putting in something like this or building a portfolio of this nature, I would look at something like that Vanguard S&P 500. That would probably be roughly 60% of my portfolio. When we look at the large cap, when we look at the IT, when we look at the ability for it to really grow, 60% of my portfolio would go into that S&P 500 fund. The other 20% I would put into 20% mid cap, 20% small cap, meaning that between the mid and the small, you have 40% of that portfolio built in. If you set that portfolio, it is literally a portfolio that you could really set it and forget it. And when you even break out this, again, a little more of a focus on the industrial, we're looking at the healthcare market, the financial, the discretionary spending, and a lot less of that focus when it comes to technology. So overall, when you think of building a portfolio and really having the ability to go into those large S&P 500, those large companies, the mid companies, and the small companies, it does make a big difference on how you break it up. That is the reason why, again, you could choose something like the VTI, put 100% in there, but a majority of it, because it is weight-based, you would be putting a lot more money into those large tech companies, which is the reason why breaking it into 3 individual ETFs like I did here today in this video makes a really big difference when it comes to the growth and really the development that we see overall. So guys, that's going to do it for today's video. Let me know what you guys think about the Vanguard funds. And as always, thank you guys for watching. What percentage of your income have you allocated to your 401k? Now, when it comes to 401ks, they are one of the best investment vehicles because they have very high contribution limits, even looking at $23,000 in 2024. And if you're over the age of 50, you can actually put over $30,000 into your 401k. And these limits are going to increase in future years because of inflation, meaning it is very possible to save $1, $2, $3, even $5 million in your 401k plan by the time you retire. Now, the most difficult part of this is actually putting money in there. For a majority of people I know, they make small contributions, might be 2%, 3%, 5%, but nobody is putting what they need to or what is recommended at the 15% into the 401k, really decreasing the odds of becoming a 401k millionaire or having enough money in there to retire comfortably, which is what we're going to be talking about in this video. 3 ways in making some adjustments in that 401k that you can retire comfortably when it comes to the time. Starting with our first one, claim as much as you can in 2024 and claiming as much of the match as possible. If your company offers a 401k match, it is free money. If they're giving you 3%, 5%, 7%, anything that you put in there, you personally have to make a contribution in there by December 31st. That is the deadline for 2024 contributions. You have to make sure that you're getting the match and that you're getting the most of the match you can. Regardless of anything, you are not going to see bigger, higher, more investable gains than getting a company match. Again, it is 100% guaranteed return on a company match. My company personally, they put in 7%. We get a 7% match on what we put in there, which is huge when you start looking at contributions. And every single 2 weeks, we're getting a 7% match. If you're not getting that match and really matching that in its entirety, you are losing money in your entirety at 100% return. Talk to your company's HR department, look at your 401k plan, see how much you've contributed this year, how close you are to the cap, and can you get to the cap? That is something to challenge. Now, there is kind of a catch-22 with this that I want to talk about. When you think of 401k plans and when you think of this match, for simply math purposes, we're going to talk 5%. So if your company is giving you a 5% match on your 401k plan, that is part of the compensation package that you're offered through the employer that you work for. If you're not taking advantage of that 5%, you are losing 5%. Now, in addition to that, is not putting the 5% in there, you're not getting that compounding interest, you're not starting seeing the growth. And of course, when you start looking at a multitude of years, the earlier that you're making these contributions, the more you can actually stack in there when it comes to. Now, of course, caveat with this is employers sometimes have a vesting period, which could be 2 years, 3 years, depending on your employer, before you could get that money, where if you're not fully invested when you leave the employer, you'll be forfeiting some or all of those 401k matching contributions, which can make a really big difference. And of course, if you're unhappy with the job, if you have a better performing job, if you have a higher paying job, you have to weigh the pros and cons. Is it worth leaving at the point you're at to actually get those 401k contributions, or do you want to stay? And also, when it comes to what you can invest in, this is the other big thing that you have to do your research. You have to know exactly what your 401k plan has, what kind of ETFs, what kind of target date funds, what does it offer in your plan specifically. That might make a difference again for that 5%. If you're matching only that 5% and then looking at Roth IRAs, looking at traditional brokerage accounts, looking at a lot of other means, if they do not have the investment vehicles that you need to really grow that wealth, that also comes with fees. The second one we're looking for opportunities to reverse or reduce your fees. Speaking of fees, this will eat in your profits. This is the reason when you start looking at expense ratios, and of course, when you start thinking of either fees that they have, investment fees, there could be fund fees, there could be advisor fees, there could be a lot of fees that are going to eat into your portfolio overall. And through the course of your life, it could eat up as much as 30% of your entire investment portfolio that you're just getting taken out in fees, which is kind of crazy. When you start looking at the funds, and again, thinking of them bundled as a package like we have with our ETFs, you have to know what funds are available and what the cost and what the expense ratio of that fund is going to be. You could be paying a monthly fee. You could be paying a bookkeeping fee. We have seen annual fees for it. We have seen a percentage base. So even if your portfolio is down, let's say 20%, they are still getting that 1% fee from managing that fund. You have to know exactly where it is and what these funds look like. And of course, review the prospectus. This is the time, again, where you have to put really the accountability in knowing what you're investing in your portfolio. Talk to your 401k plan provider, even, and I do stress, talk to someone outside of the company, talk to someone outside of that 401k provider, look at the investment strategy. If it aligns, great. If they're greatly different, you might want to get, again, a second advice, talking to someone, looking at what is available, what makes sense. So when I started personally looking at my target date funds, the target date funds had a much lower return than we've seen with the traditional ETF funds. They also had a much higher fee than we've seen with those traditional ETFs. So I switched many years ago, got out of those target date funds, which were through Vanguard. I was looking at Vanguard, I think 2045 or a 2050 plan. The fund provided a much lower return at a much higher cost, which of course could make a really big difference when you start extending it even over the last decade. I have seen amazing returns investing into something like the S&P 500 ETF versus having it into those target date funds. The final one we look at is planning your strategy for 2025. Now, as it sits right now, we do have everything that is going on. Open enrollment for a majority of companies are here, meaning what is the strategy for 2025? When you think about your 401k, your HSA, when you look at IRAs, when you look at your MESP programs, when you look at everything big picture, what is the plan? What is the contributions going to look like? What is your retirement savings plan? What is it going to look like? Are you putting money into your 401k first to get the match? Are you going above and beyond that 401k? Again, if they're matching 5% and we're looking to get into 15%, and also taking a really hard look of the pros and cons of traditional 401ks and Roth 401ks. Now, of course, most people have access to those traditional 401ks, which give you that upfront tax break, making it valuable if you're in a very high tax bracket. But when you start looking at a multitude of years, essentially the way that I see it is a traditional plan. You are kicking your tax liability down the road. You are also allowing that 401k plan to grow into a gigantic, massive nest egg that now you're going to have to pay taxes on when you get down the road. You could even do like I do and actually split it up between traditional and Roth, putting roughly 30% to traditional, meaning that nest egg is going to be a lot smaller. But with that traditional portion, I know that is going to be the supplement that I'm going to use to supplement my Social Security income. The Roth money is what I plan to leave in the entirety with generational wealth that is going to be completely tax-free. Now, of course, when you start looking at the variation, Roth will beat out the traditional. Even during retirement, if you are in a lower tax bracket, you've already paid the taxes, you know exactly what you owe. You're not required to take RMDs. That's another really big thing where with the traditional plan, you're going to be required to take required minimum distribution, or RMDs want to hit a certain age. And I believe right now it is 73, meaning you're going to have to take that money regardless if you want to take it. When you take the money out with RMDs, you're required to pay taxes. So again, it could eat up a big chunk of your nest egg. And also depending how big that nest egg is, you could be into a higher tax bracket if you're required. If you have a couple $1 million nest egg, it could make a big difference when you have to take money out and what you have to do with really taking it out and paying taxes on a much higher amount, again, can put you into a higher tax bracket. So again, when you think of the 401k plan, Roth 401k is what I'm going into. Want to make sure you're not going over your annual contribution limits, which is that $23,000. And for most employers, if you go over that limit, your employer will refund that difference back to you. You have to make sure going into 2025, getting ready for next year, you have your retirement savings strategy really in place. Your HSA contributions, you know what they're going to look like. If you're in a high deductible healthcare plan, what you're putting into IRAs, what you're putting into brokerage accounts, where is the plan for future you that is going to thank you again in the future when it comes to these savings? Making and really looking at your plan on a regular basis, making sure you're in the best investment strategy and the best investment in general when it comes to the 401k plan is going to make a big difference for you in the long run. So all right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think, and I'll catch you in the next video. Have you caught the FOMO yet? That is the fear of missing out. Anxiety when we start seeing Bitcoin or really any stocks, any ETFs really skyrocket because they're seeing all their friends taking profit and hearing about all these stories on social media, and they don't want to be sidelined. They want to get in on some of the action. When you start thinking of Bitcoin in general, we know that it's been kind of crazy, even looking at the altcoins, that when it comes to FOMO, I'm going to be going through in this video how really to avoid it. And this is something years ago that I fell trapped to when cryptocurrency was really hot years ago, getting in and getting out kind of at the wrong time, and knowing exactly what it is, starting with setting your investment goals. This is the question that I've gotten from a lot of individuals is how do you get rid of the FOMO, or how do you stop the FOMO investing? Really going in, it is having a plan. When I have people that come to me and talk about investing into cryptocurrency, I fire back with, what do you know about it? How much have you researched it before you just start investing? Because you're seeing it on the news, you're seeing it all over social media and everywhere else. You have to have a well-defined plan of exactly what you're going to do. What is your investing timeline? When are you getting in? Are you going to hold it for 4 to 5 years? Are you looking to get some quick gains? You really have to know exactly what it is, and also your risk tolerance. If you're putting money into something like cryptocurrency, you have to make sure, what are you comfortable with? If Bitcoin, let's say, goes down to 80, 85, let's say it goes to 75, back to 65, what is going to be the emotional reaction? At what point are you just going to cut your losses and get out of this? Or are you looking at that long-term investment guideline that a lot of people look at? Now, for me personally, I do invest in cryptocurrency, and I do it through dollar cost averaging. So very similar to what we see with my ETF portfolio. I do dollar cost averaging into Bitcoin. I do dollar cost averaging into a few altcoins. Me being a gamer itself, there are a lot of crypto games out there, including Guild of Guardians, which I do play and very adamant and avid about. But when it comes to dollar cost averaging, you have a very set amount of money put aside. And let's say it's $50 a month, and that's what you're willing to put into Bitcoin. Putting that $50 into Bitcoin, if the price is 30K, 60K, 100K, putting that $50 into Bitcoin, avoid buying peaks, buying the troughs, getting and really building a gradual position into something like cryptocurrency. But this can be applied to the exact same thing when it comes to investing. Doing the dollar cost averaging, knowing in your budget that, again, let's say you have $50 that you're putting in every paycheck or $50 you're putting in every single month. You're going to do that regardless of where the market is. If it's up, if it's down, you are still going to put that money into the market regardless of everything. And this really gets rid of and really reduces and eliminates emotional decisions. If you feel some anxiety about investing, if you feel anything, don't panic buy, don't panic sell, don't do anything. It is making a long-term plan, writing that plan down on paper and sticking to that plan regardless of what happens in the market, regardless of what you hear on social media, regardless of what you see in the news and what's coming in the future. Guys, it's about the time that you're investing in the market, not really timing the market. The more time and the more that you can dollar cost average into the market, the better position you're going to really be in. Now, you also have to remember that corrections are common and that adjustments are common. It's not every day when the stock market is going to be just going up and up and up. Same with cryptocurrency. Corrections are normal. Corrections, and this again is going back to that very good plan that we have set in place where, hey, I want a dollar cost average into something like Bitcoin. I'm going to do $50 a month. I'm going to do it for the next 4 years. No buying, no selling. It is really sticking to that, putting that $50 in. That's it. If it goes down, you're still putting $50 in. And again, if it goes up, you're still putting that $50 in. So when you start looking and thinking, again, this article kind of covers cryptocurrency. When you look at technical indicators, this is where if it gets very, very data and very analytical, for a lot of people, they bow out. Me personally, I want an entire hands-off approach. I don't want anything that I have to monitor, that I have to track. Because also remember, if you're starting to get into the Bitcoin, if you're going into the FOMO and really want to avoid it, Bitcoin cryptocurrency runs 24/7. You might go to sleep tonight, everything's good, your Bitcoin's at 85K. Tomorrow you might wake up, Bitcoin dropped considerably, it's at 82. A lot of people will panic sell and will get rid of it and eliminate it at that point. You also want to know that when you're getting into positions is what is the entry, what is the exit, and what does it look like? This is where, hey, I want to get into a position, deciding on the level that you're comfortable with at a price that you are, or looking at either dollar cost averaging or a very, very specific amount. When we start looking at something like Tesla, when you look at NVIDIA, where NVIDIA is up 2,500% in the last 5 years, every point along the way of the investing journey, people said NVIDIA is overpriced. It's overpriced, it's overpriced. We've seen the same thing even years ago with Tesla, way overvalued, overvalued, overvalued. Now we're seeing the exact same thing. And again, I wanted to do this video because I'm getting a lot of comments and a lot of questions about Bitcoin. Is it overpriced now? That's what people have been saying forever, guys. There is not really a point where it's going to be overpriced. There's going to be a point where you're purchasing it. The future value cannot be determined and will not be determined by today. It is something that is going to be in the future. If you find value in Bitcoin, just like you find value with US-based companies, that you find value with ETF investing, with the HD, with dividend investing, with income, it makes a big difference on what you believe in, where you think it's going. And again, taking out the FOMO, regardless of what people say, regardless of the things you're seeing in the media. And also, what is the strategy? Me personally, I'm 45 years old, thinking of a 20-year strategy, and that's what I have mapped out. I know right now that we're putting money into ETFs. We know that we have a big chunk of that into the growth ETFs. We also have a portion of that into the dividend ETF, and we also have a portion of that into the core, the VOO, that ETF as well. The percentages are going to change every roughly 3 to 5 years, depending on where we're at. putting a lot more into dividend income. It is the exact same with Bitcoin and with cryptocurrency. Is what is your risk and what is your tolerance? When I start looking at this, I allocate 2%. That's right, only 2% of my entire portfolio I do put into Bitcoin. But you know what? It's 2% that a lot more people are doing. I'm not taking a ton of exposure. I'm not going like an Andre Jink, where we're putting 20% into Bitcoin of the portfolio in its entirety. Yes, I do like Bitcoin. I think there's a lot of practical applications, but having some exposure to it, in my opinion, does make a big difference. And it does really align with a lot of people's strategies. Even looking bigger picture, when you start looking at corporate investors, companies are starting to put cryptocurrency through ETFs. We're seeing it with Bitcoin. We're seeing it with the Ethereum ETFs, that they are starting to take a stake into the cryptocurrency. Now, the big thing with this, and to stay away from FOMO, is staying informed, but you have to filter out the noise. This is the most difficult thing when you look at news, social media, online communities, posts, Discord, Telegram, everywhere. You have to make sure, because there's so much exposure, can really overhype and can trigger FOMO for a lot of different people. Some people that don't know zero, absolutely nothing when it comes to cryptocurrency or when it comes to investing in general will all of a sudden go all in. You're gambling. It's like playing a poker hand where you only see 2 of the 5 cards. Those 2 cards, you're making all of your bets based on it. And of course, most people do lose at that point because they'll go in at a certain price. The price will come down. They'll say, oh no, panic sell, just go ahead and liquidate it. Now they took a loss. Now they have that bitter taste in their mouth. They don't want to do it anymore. They want to stay away from it, and they do not want to go ahead and research. Now, like I've said before, and I'll say it again every single time, you have to look at Bitcoin's fundamentals. You have to look at investing fundamentals, know exactly what you're investing in, what Bitcoin does, what the decentralized currency is, what the exchanges are, where to buy Bitcoin. You have to really don't compare your journey to anyone else. Your journey, your investment journey, the reason why you want to invest, the reason why you want to build wealth, whether it's generational wealth or it's wealth for yourself, it is going to be your own individual journey. That is why when personally I sit down and do financial education and counseling with people, we come up with a plan. We don't want to copy the plan. I don't want you to use my plan. I do not want you to mirror all the portfolios that I built, even though I do incredibly well. I want to guide you down the path of knowledge and knowing exactly what to look at and what to kind of get into. You have to manage FOMO with discipline and really patience. Again, as Bitcoin approaches that $100,000 mark, a lot of people tempted to go FOMO, and they don't even know where the FOMO will end and how many of these individuals that have been investing in cryptocurrency over the last couple of days are really the FOMO buyers. Is it the long-term kind of buy and hold mentality? What is it looking for? But again, you have to make sure that you do not go in with an emotional mindset, that you have a plan on how you're going in, how long you're going to be in, when you're going to get out, what price you're looking at. If you're going at a dollar cost averaging, are you putting just a big lump sum in there? Which I do not recommend at all, because of course, let's say you put a lump sum, let's say you got $20,000, you throw it in there. Again, you can have a much larger gain, of course, with a much higher risk, but you can also have a drawback and have a much bigger loss, amplified loss, because of the money you're putting in there. And again, that's where dollar cost averaging comes in. That's what I've actually done over the last 10 years. It has been incredibly successful with dollar cost averaging. So to manage the FOMO, to really eliminate it, patience, discipline, strategic planning, know exactly sticking to your goals. Where are you going to be? How long are you investing? What is the plan to get out in? Are you planning to get out? Are you planning to sell? Me personally, ETFs, Bitcoin, all of this, I don't plan selling it at any point. It is going to be something that is going to create generational wealth for my family, and making sure that we are sustaining what we have in the investment is growing over time. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.